All right, let's dive in. We're going to talk about accounting today, but probably not in the way you're used to thinking about it. We're not just crunching numbers here. We're talking about strategy. And we're going to zero in on one really powerful and kind of controversial tool in a manager's toolkit, an inventory method called LIFO.
So, let's kick things off with a pretty big question. I mean, can a simple accounting rule, something that feels like it's just on paper, can it actually change how much a company pays in taxes? And can it change the profit that it reports to the world? Well, the answer is a huge yes, and figuring out how this works is, frankly, a game changer for anyone in management.
Okay, so here's our game plan. First, we'll look at accounting as a strategic tool. Then we'll get into what LIFO actually is. After that, we'll see how it hits the income statement and then the balance sheet. And finally, we'll put it all together to understand the big trade-off that managers have to make.
All right, Section 1, Accounting as Strategy. The key here is that it's not just about the numbers. It's about the choices behind them.
You know, most of us think of accounting as super rigid, right? A bunch of hard and fast rules you just have to follow. But the truth is, managers actually have some wiggle room. They can make choices that totally change the financial story a company tells. And one of the biggest choices they have to make, it all comes down to how they account for their inventory. Which brings us right to our main topic. What is LIFO? Let's get into this last in, first out idea.
So, LIFO stands for last in, first out. At its core, it's an accounting method based on one simple assumption. The newest stuff you bought, that's the first stuff you sold. And that word, assumption, is absolutely crucial. This is an accounting choice, not necessarily a reflection of how products are physically moving off your shelves.
Okay, to make this super clear, let's think about a grocery store shelf. Imagine you put a can on the shelf, and it costs you $10. Then, a week later, prices have gone up, and you stock another identical can right next to it, but this one costs you $15. Now, a customer comes along and buys one can. Under LIFO, what do? We assume they bought the last one in, the most recent one, so the cost of that sale gets recorded as $15.
Okay, so that's the basic idea. But how does this one little choice about a can on a shelf actually affect a company's finances? Well, that's where we have to look at the income statement. This is where things get really interesting. Now, this whole LIFO thing becomes really important when prices are going up, during a period of inflation. Think about it. If prices are rising, then the last items you buy, the last in, are pretty much always going to be the most expensive ones on your shelf. And what's the result of that? Well, because you're assuming you sold your most expensive inventory first, your cost of goods sold, what we call CGS, is going to be higher with LIFO than with other methods. What you're really doing is matching your most recent higher costs against your current revenue.
And the math here is pretty straightforward. Your profit is basically your revenue minus your costs. So if your cost of goods sold is higher, it just follows that your reported net income, your profit on paper, is going to be lower. Simple as that.
Now, you might be thinking, wait a minute, why would anyone want to report lower profits? And that brings us to the real strategic reason for using LIFO. Lower reported income means, you guessed it, a lower tax bill. During inflation, a company can use LIFO to legally pay less in taxes and, more importantly, keep more cash in its pocket. But, like with everything in business, there's a flip side. There's no free lunch, right? So let's look at the other side of the LIFO coin. Its effect on the balance sheet. Let's go back to our grocery shelf for a second. If your books say you've sold all the new, expensive cans, what's still left on the shelves, at least according to your accounting records?
Right, you're left with the old stuff, the cheap stuff you bought way back when. And this has a direct impact. The value of your inventory as an asset on your balance sheet is now based on those old, outdated costs. It's often way lower than what the inventory is actually worth today. And this can create a huge gap. A real disconnect. The value on your books, the LIFO value, might be based on prices from 5, 10, even 20 years ago. Meanwhile, the actual cost to go out and replace that inventory today, the current market value, is way, way higher. So you see, we have these two things pulling in opposite directions. And that brings us to the heart of the matter, the LIFO trade-off. This is where managers have to make a really tough strategic call.
Let's just quickly recap the whole domino effect here. When prices are rising, if you choose LIFO, your cost of goods sold goes up. That pushes your net income down. And because your income is lower, your taxes go down, which is awesome, right? That's the benefit. But the cost, the trade-off, is that the inventory value on your balance sheet also goes down.
So here's the choice, laid out plain and simple. You'd pick LIFO if you want to pay less in taxes right now and get a better match between your current costs and revenues, but you have to be okay with telling investors that your profits are lower,
And you have to be okay with your balance sheet showing an inventory value that looks pretty low, which could make things like getting a loan a little trickier.
So, in the end, it all comes down to this one crucial question for any manager. What story do you want your financial statements to tell? Do you want to show higher profits to impress your investors, or do you want to show lower profits to the tax authorities to save cash? That right there is the essential LIFO trade-off.